In the first 6 months of this year, one hedge fund returned 439%. Not 4%, not 39, 439. Its founder had written the essay half of Silicon Valley was quoting, 165 pages about the single most valuable skill of the coming decade, the ability to see what's coming before everyone else. He named the fund after it. 6 trading days. That's how long it took, in late July, for all of it to vanish into a single phone call from a bigger fund. And the reason it vanished isn't the reason everyone thinks. Keep that 400% number in your head, because it's about to mean the exact opposite of what it looks like. Leopold Aschenbrenner is, at the time of this recording, still in his mid-20s, and the resume isn't the impressive part. What he built with it is. He finished top of his class at Columbia at 19. He spent a stretch at the Future Fund, the philanthropic arm of a company called FTX, and left before that company detonated in 2022. Then he landed on the team everyone in AI wanted, OpenAI's superalignment group, the people meant to keep a superintelligence from going wrong. In 2024, OpenAI fired him. He has said it was for raising security concerns. OpenAI disputed that. But getting fired turned out to be the best thing that ever happened to his bank account. Here's what he did with it. In June 2024, he published Situational Awareness, 165 pages arguing that artificial general intelligence was arriving faster than anyone was pricing in, and that the entire physical backbone of AI, the chips, the data centers, the power, was about to be worth almost unimaginable sums. The essay didn't hedge. It put dates on it. It named the decade. And for a document written by someone who had just been shown the door, it was read like scripture in exactly the rooms that had shown him the door. Then he did the thing essayists almost never do. He put money behind the words. Late in 2024, he launched a hedge fund, Situational Awareness LP, with about $225 million. The strategy was just the essay turned into a trade. Go long the infrastructure of AI and short the old software he believed AI would eat. And the people who lined up to hand a 23-year-old their money should have known, better than anyone, what came next. Stripe's founders, the Collison brothers, Nat Friedman, who used to run GitHub, Daniel Gross, and, unusually for a fund this young, the quantitative giant Jane Street, people who model risk for a living. For 18 months, they looked like geniuses right along with him. Watch how fast that flips. By mid-2026, the fund managed something like $20 billion, and in the first half of the year, it returned 439%. The board, so to speak, was delighted. Nobody asked the obvious question. Where does a return that big actually come from? The answer is the whole story, and it's hiding in a number he never put on a slide. Here's that number. The fund had roughly $20 billion of investors' money. But at its peak, in early July, it controlled around $45 billion of market positions, $20 billion of real money, $45 billion of exposure. That gap is the entire story, and it has a name. Leverage. And once you see what leverage actually does, the 400% return stops looking like genius and starts looking like a countdown. Situational Awareness was running leverage reported at up to 4 times. For every dollar an investor put in, the fund borrowed roughly 3 more and bet all 4. Here's what that does to you. Leverage is a multiplier, and it does not care which direction you're moving. At 4 times leverage, you don't need a crash to lose everything. You need the market to move about 25% against you. That's the whole margin for error, 25%. Sit with that number, 25%, because the market is about to hand him almost double it. So 439% was never a measure of how right he was. It was a measure of how borrowed he was. The same 4 times multiplier that turned a good year into a headline was sitting there, quietly, waiting to run the film backwards. And then a second problem stacked on top of the first, the one that turned a bad month into a fatal one. The book wasn't just leveraged, it was concentrated. The same bet, over and over. SK Hynix, CoreWeave, Micron, Nebius, Bloom Energy. The picks and shovels of the AI boom all in one pile, one bet. And July was about to test every dollar of it at once. That pile fell, not catastrophically, between 35 and 47%. In an unleveraged fund, a painful month. At 4 times leverage, a funeral. But here's the part that actually sealed it, and it's the detail the reaction videos skip. At the exact moment his longs were falling, the stocks he'd bet against, old software names like Adobe, went up. He was losing on both sides of the book at once. The one thing a leveraged fund cannot survive. After that, the math takes over. When leveraged positions fall, the banks that lent the money, Bank of America, Goldman Sachs, JP Morgan. Make a call. A margin call. Post more cash today, or we sell you out. He couldn't. Almost nobody in that position ever can. 6 trading days. That's the whole collapse, and Wall Street had seen this exact movie 5 years earlier. In 2021, a fund called Archegos, run by a man named Bill Huang, died the same way. Concentrated, leveraged, wrong-footed for a few days, then margin called into nothing over a single week, taking more than $20 billion with it and leaving its banks nursing billions in losses. Wall Street didn't just know this story. It had built training decks about it. Huang was later convicted. The mechanism that undid him became a textbook case in exactly how much leverage a concentrated book can hide, right up until it can't. But knowing how the movie ends doesn't stop you from starring in it, especially when you're 23, and the last 18 months have told you the old rules were written for people who couldn't see what you could. The man whose entire brand was foresight had built the one structure the market had most recently taught everyone to fear. On the 30th of July, Situational Awareness sold its entire public portfolio in a single block trade. And the name of the buyer is the twist of the knife. It was Citadel, Ken Griffin's firm, one of the largest, most establishment hedge funds on earth. It bought the young man's positions at a discount, the way you buy anything from someone who has no choice but to sell. The fund's exposure fell from around $45 billion toward 10. In 6 days, the fastest-growing fund almost anyone could remember became a forced sale line on a bigger firm's books. But here's the part that lands last. The detail that proves the AI bet was never even the problem. Once the forced selling finished, the semiconductor stocks he'd been holding bounced. The market treated his collapse not as a verdict on AI, but as plumbing, a big leveraged seller getting cleared out. The thesis didn't die. The leverage did. Who got hurt? The investors, the Collisons, Jane Street, the rest, took losses that, as of this recording, nobody has put a public number on. Don't let anyone tell you they know it yet. Who walked away fine? Citadel, holding assets it bought cheap. The prime brokers, who by design get paid and get out first. And Aschenbrenner himself kept exactly one thing, and which thing he kept is the most revealing detail in the entire story. His leveraged public bets are gone, but according to reporting, the fund still holds the one position it was never margin called on, its private shares in the AI lab Anthropic. Read that twice. The leverage destroyed the bets he could sell in a panic. The one wager that survived was the illiquid one, the bet nobody could force him out of. As of this recording. He has said almost nothing publicly. The essay was right about one thing: situational awareness, seeing what's coming before everyone else, is the most valuable skill there is. He just aimed it at the entire future of civilization, and never once at his own margin account. The returns were never foresight. They were leverage wearing foresight's clothes. A 23-year-old borrowed 4 times over on the future, and got margin called by the present.